Advisory services offered through VestGen Advisors, LLC, an SEC-registered investment advisor. Securities offered through Private Client Services, LLC, member FINRA and SIPC. Private Client Services and VestGen Advisors, LLC are unaffiliated entities. Any information discussed does not constitute investment advice. VestGen Advisors and Private Client Services do not offer tax or legal advice. People of Chicago, welcome to In the Know Radio with Craig Bolanos, co-founder and wealth advisor at VestGen Wealth Partners. You want help from someone you can trust, someone who knows what it takes to get retired and stay retired. Today, Craig's going to teach you what you need to know. So get ready to learn something that could change your life. Get connected to the show by calling 833-964-PLAN or go to getretiredstayretired.com. And now, here's Craig Bolanos.
Hey, good morning and a very happy Sunday to you. I got news. Whether your retirement dreams are just 5 short years away or maybe they're 50 years away, the single greatest threat standing in your way, it's taxes. Because unlike the volatility, losses that are temporary in the stock market, money lost to taxes, I got news. It never recovers. And with untaxed retirement accounts likely to become or already are your single largest asset, you face an explosive landscape of costly tax trap penalties and a complex maze of rules when it comes time to tap those retirement savings. So here to discuss with us how we're going to navigate that retirement tax time bomb is David, one of the best advisors at VestGen Wealth Partners. David, what are some of the considerations and talking points that you use with clients as to why they want to find ways to mitigate the ticking time bomb that is taxes in retirement?
I would start first with bracketology. I know it's already the middle of June, but when I'm thinking bracketology, I'm not thinking March Madness. I'm thinking about how long can your family stay in a particular marginal tax rate? And for a lot of retirees, we're playing the 12, 22, or 24% marginal rates. And I think unbeknownst to a lot of retirees, many are close to staying in that 12 or could just be over. And where we want to spend time is what are the components that are going to affect that marginal tax rate? And maybe we can just take these one thing at a time, but I would start with what are our distributions going to look like from pre-tax IRAs and pre-tax 401k contributions? Number 2, I would say, how are your non-qualified taxable accounts used in your retirement plan? Are you going to be selling assets, realizing capital gains, and generating dividends? Or is that money that you're going to use at a later date, or perhaps not at all?
So David, let's role play this out. So if a client comes in, a prospective client comes in to visit VestGen Wealth Partners, let's talk about how we're going to engineer that tax efficient withdrawal. I think the first thing that we're going to have a discussion about is how much people need to retire and also how much they want to have to retire. Because the reality is we're here in a role of service and our job is to optimize the withdrawals so clients keep as much of their income as possible. So gone are the days of the 80s, 90s, and 2000s when people simply spent down non-retirement accounts first, tax-deferred accounts second, and then relied on tax-free account last. That is absolutely crazy for all the reasons that everybody knows, which is, by the way, the IRS might just be the biggest beneficiary listed on your IRAs and 401ks, everybody. So when you come in, we're going to talk about the needs, then we're going to talk about the wants. Most importantly, you're coming in for what we know you desire, the solutions. And those solutions are going to be filling up the 10 and 12% marginal tax rate first. And possibly, if it works, we find a way after deductions to keep you in that 10 to 12% marginal tax rate. Because if you can suck money out of a retirement account at such a benign rate as 10 or 12%, I think that's a win. But when you fall in that 10 or 12% rate, you also qualify for something. It's the power of zero. What's the power of zero, David?
Yeah, the power of zero is you might qualify for 0% capital gains taxes. So if you sell a stock, ETF, or mutual fund for a profit in your non-qualified investment accounts, wouldn't it be nice not to pay any tax? Craig, reminds me of a meeting I just had. We were planning on a specific amount of savings every month, and it happened to be around $12,000. And I think the client perhaps had forgot that was like our initial goal that we had set in an earlier meeting. But he said, why did you set it there in this particular example? I said, well, look, if we start adding up how we're going to get to the 12, I'm pretty confident we can get you $12,000 a month. And also, most importantly, keep you in that 12% marginal tax rate. And he said, well, why do we want to do that? And as you were alluding to, I said back to him, I said, well, look, when you guys were working, you were in the 32% marginal bracket. You've never been in the 12. And that's the real financial planning. It's getting a tax deduction at a 32% marginal bracket as you're adding to your 401k, but getting the money out of your IRA at 12. And I said, more importantly, we don't want to miss out on things like the senior bonus deduction while it lasts the next several years. More importantly, I want to be able to do some Roth conversions for you the first 2 years of retirement. So if we start to combine these different sources, meaning it's not just going to be straight distributions from the trust account, it's really going to be a combination of pension, one Social Security, not two, non-qualified investments. We add all that stuff up. We need to start connecting the dots on several victories. And as I outlined it, I said, here's the reason why. I want to do Roth conversions. I want a low capital gains tax. I want you to get the senior bonus deduction for as long as possible. And I want to start moving money out of your pre-tax IRA so that when you hit 73, you're not caught off guard by larger RMDs. If we do that, we're winning. And then the investments are almost secondary because this is so important.
Absolutely. 833-964-PLAN. 833-964-PLAN. Go out to our website, getretiredstayretired.com. That's getretiredstayretired.com. What we're talking about this morning in the A block is the tax time bomb. Traditional IRAs, 401ks, they're not tax-free. They're tax-deferred. Every dollar eventually becomes taxable when the money comes out. And so many of us, so many of you, those that are listening, you have larger balances than previous generations because of decades of market growth. And you accept, as do I, that future tax rates are going to have to be higher than today's rates due to the substantial government debt and spending pressures based on the demographics, the demography of the United States. So if you want to learn how VestGen Wealth Partners goes ahead and creates defined outcomes so you too can start thriving, not just surviving in retirement by saving on TIR, taxes in retirement, give us a call, 833-964-PLAN, 833-964-PLAN, getretiredstayretired.com. Because you don't own 100% of your IRA. The government owns a percentage too. So David, you mentioned these Roth conversions. You oftentimes talk about Roth conversions in the valley of income. Help us understand where that intersection usually is for all the clients that you support at VestGen.
I'll give you an example using the same family. So it was a retirement that happened to be at the exact same time. So husband and wife are retiring in 26, and they have non-qualified assets. They have pre-tax IRAs, 401ks, they have pensions, and they have Social Security. But the really cool thing about it is we aren't going to be forced to turn any of those sources on if we don't want to. So we dictate the income. So we can dictate what marginal tax break we want to, what marginal tax rate we want to be in. So together we decided, we're going to turn on all of the pension income, and we're going to turn on one Social Security. We want to delay the second Social Security for spousal protection. I want that money to grow. We don't need it right now. And we're going to fill the gap, that spending gap, with distributions from non-qualified assets. That way we get to stay in the 12% tax rate. That way we get to do some fairly large conversions the first couple of years of retirement, because again, the wages are gone. So we are going to be able to turn on and off the faucet on all of these things. So early on, I think, is the sweet spot for larger conversions. And, the clients asked a really good question too. They said, hey, look, we're going to eventually have to replace a car early on in retirement. Is that going to put us in a difficult position? Is that going to knock us out of that marginal bracket? And I said, no, we already accounted for that. We have the money set aside for the home projects for that in accounts that we can withdraw from either tax-free or with minimal capital gains. That's all designed on purpose. And I think that's the takeaway for our listeners today is if they're not going into your existing counsel, is not going into the detail, they haven't thought about some of those contingency plans, I really think you're missing the boat. Because what's more important, owning a tech stock ETF versus a growth ETF, or having distributions taxed at 10 or 12% versus 24 or 32? In my personal opinion, and it's vetted in the research, I'd rather save taxes. That's way more powerful than having an intellectual argument about investment A versus investment B.
That's exactly right. So retirement planning without tax planning, it's only half of a plan. And remember, tax deferral is never tax elimination. So the goal isn't about avoiding taxes. It's just a part of the system we live in. It's about controlling when and how much the taxes are that are paid. And that allows you to worry less, which allows you to live more and enjoy the lifestyle that you've worked an entire time period to achieve. So I want you to connect with us. 833-964-PLAN. That's 833-964-PLAN. Go out to our website at getretired.stay-retired.com. We're going to talk more about the widow's penalty. Yeah, the widow's penalty. You want to hear about this when we come back. You're listening to Craig and David Bolanos. That's Craig and David Bolanos in the Know Radio, VestGen Wealth Partners, AM 560, The Answer.
You want more in the Know Radio? You want more in the Know Radio? You can't handle more in the Know Radio. Okay, yeah, you can. And it's on AM 560, The Answer. Welcome back. Here's more with Craig.
So I want to talk about something that doesn't get enough press. Now, it gets plenty of discussion, plenty of strategy, and plenty of cure at VestGen Wealth Partners, but the retirement tax trap that nobody talks about is nothing short of a retirement tax shock, and it catches families completely off guard. You have a married couple, a husband and wife. They spend decades savings together, but when one spouse dies, the survivor may end up paying significantly more in taxes. And yeah, death and taxes, they're inevitable, but I think too many retirees don't realize that one often makes the other so much worse. So welcome to the widow's penalty. And what is that widow's penalty? When a married couple is filing joint, they benefit. I'm married. David, you're married. We have incredibly wide tax brackets, courtesy of the current administration, incredibly wide, larger standard deductions. But when one spouse dies, the survivor is typically filing as a single. The tax brackets shrink, the deductions shrink, and all of a sudden the same or lower income can generate in catapulting to a significantly higher tax bill. David, how many married couples right now are in a 12% marginal bracket, but one spouse dies? They go from 2 Social Security incomes to 1, but guess what? The survivor ends up moving from the 12% marginal tax bracket to 22. That's a 10% widow's penalty. That's like saying the first 10% you earn on your investments now just went to taxes. Strategy number 2, or family number 2, they retire. They're high achievers, higher income. While they're retired, they're in the 24% marginal tax bracket. One spouse dies. The trust accounts aren't disappearing. The IRAs aren't disappearing. The interest and dividends aren't going anywhere. Sure, we went from 2 Social Security payments to 1, but the year following the death of the spouse, the survivor is single, and they catapult from that 24% bracket to the next rung on the ladder, which is 32. That's an 8%, 24 to 32. That's an 8% tax shock. That's like saying the first 8% you earn on your money is now just going to taxes. David, we got to solve it. What are we doing at VestGen Wealth Partners to solve for the widow's penalty?
Well, I'm going to throw in one more before we talk about solving it, which is not as important as opposed to like an 8% jump in your income tax, which is IRMA, right? Because once you start making these moves, that likely affects how much you pay for your Medicare premiums. And while I always tell people paying these IRMA surcharges probably won't financially ruin you, they will certainly make you a little bit upset. So let's avoid that if we can. Well, I think option one is what we talked about in the A block, Craig, which is this is why we have to consider Roth conversions to ensure that perhaps the RMD amounts aren't going to push us into the next bracket. There's lots of reasons people do Roth conversions. And quite frankly, I think that is an oversold topic. The concept that everybody should be doing that, to me, is totally flawed. But once we start getting into these harder conversations and people start figuring out that they're playing the back nine, we need to figure out what these RMDs are going to look like in the future. And since we can't stop them, we have to pull the money out. Does it make sense to fill up the 22% marginal bracket now to start avoiding some of these things in the future? Or if we're going to avoid them, I think charity number one is it's the kids. We probably don't want to be giving all of these RMDs away through QCDs. I know that's a clever way that people do it, is they say, hey, look, we can avoid the income tax by donating to charity. But typically charity number one is your family. So perhaps we should look at better ways to give within the family first. The QCDs to me are a secondary option in that scenario.
So if you're just joining us, we're talking about the widow's penalty. It's the retirement tax trap that nobody pays attention to, and they get blindsided when people go from a single tax filer to a joint filer. So here's what I offer you. Part number one, actions that you can take today. Know your survivor tax rate. You come in and discuss with us at VestGen Wealth Partners, we'll help ensure that you know your survivor tax rate. And if you have never calculated your survivor tax rate, if your advisor doesn't know what that is, I got news. You're only playing with half the map, half the dice. That's not good. Number two, in the valley of retirement income, you got to be doing what David talked about in that A block. Consider the Roth conversions and consider a blended retiree income distribution schedule to optimize and future-proof away from this massive widow penalty. Number three on my list, it's all about the simulations. It's about the stress test. You got to stress test the retirement plan. That's multiple scenarios. What if one party, one spouse dies early? What if they die late? What are the intersections we need to do between those goalposts to manage effectively, to diversify away the widow's penalty and plan for survivor income and survivor risk? So make sure you're using the joint years wisely. Make sure you are protected from the widow's penalty. 833-964-PLAN. That's 833-964-PLAN. Go out to our website, getretiredstayretired.com. That's getretiredstayretired.com. When you're there, download some of our most important guides, like an introduction to real return. Because again, you don't spend percentages in retirement. The thing you got to do in retirement is protect purchasing power. And that's why the concept of real return investing is resonating with everybody. So remember, most couples spend decades planning for retirement, but very few spend time planning for the retirement of the survivor. That widow's penalty isn't really an estate planning problem. It is a tax planning problem. So let's make sure that the strategies that you're getting from your team are going to create lasting strategies where your money's going to last. 833-964-PLAN. Go out to our website, getretiredstayretired.com. Now, David, you've mentioned a number of examples of clients that you've helped recently. As we close out the B block this morning, whether it's taxes in retirement, diffusing the time bomb, whether it's finding strategies to help future-proof what I call survivor risk, aka the widow's penalty. What's an example of a family that you've met through the radio recently that came in regarding whatever topic it was? How did you help them seek improved and defined outcomes from their current situation?
Well, it's something we didn't jump into right away, but I think it's equally important. We'll dive into the weeds a little bit, which is how these investments will flow through your tax return. So, when I meet with a couple and they've done an excellent job savings, right? I mean, in addition to IRAs and 401ks, they probably have stock portfolios. So they're generating dividends. I believe cash is an asset class. A lot of people have done a great job putting dollars into CDs that are earning 4 or 5%. But, speaking of this widow penalty, Craig, upon first death, it might feel good that you have $40,000 of taxable interest on your tax return because there's a lot of money tied up in CDs, and people like that certainty of CDs. But all of a sudden, that $40,000 of taxable income on Social Security, we're going to be above some of these thresholds immediately. So where we really need to start planning is different investments belong in different types of accounts. So if you're going to be perhaps using a high dividend stock strategy, wouldn't it make more sense to own some of those high dividend yielders in tax preference accounts? Maybe if you want to.
You're referring to asset location. So David, succinctly talk about how people at VestGen Wealth Partners benefit from proper asset location.
It's not what you earn, it's what you keep. There's interest that's taxed at ordinary income. We have dividends, ordinary dividends, qualified dividends, and then we have investment strategies that are what I call return of capital. It's pass-through appreciation. So the depreciation, so it's not fully taxable. And those investments need to be aligned with your family's marginal tax rate. And once we start creating those synergies, that's where all the juice is. Because once you start to see that you can make 4%, but that 4% isn't tax-free, depending on your marginal tax rate, that could be almost 2x the same type of return you could be getting in some type of CD. So I think it's about doing the due diligence and finding folks that understand the differences and that are willing to spend the time to educate you and say, hey, look, there are some other opportunities that your family would benefit from. You just haven't had the opportunity to learn about them. That's what VestGen does a very good job doing. It's educating people on what the opportunities are so they can make those decisions.
So asset location is about holding the right type of dividends in the right type of tax account. Making sure you never hold the wrong dividends in the wrong account. Not all interest income is created the same, making sure that's located properly. It's really about asset location of securities across taxable, tax deferred, and forever tax-free accounts. That's the game changer. Get in touch with myself. Get in touch with David, 833-964-PLAN. Go out to our website, GetRetiredStayRetired.com. That's GetRetiredStayRetired.com. More to come after this commercial break. You're listening to In the Know Radio with Craig and David Bolanos, AM 560, The Answer.
Would you like a dose of knowledge? Good, because Craig is back and about to fill your retirement prescription. Back to In the Know Radio on AM 560. The Answer.
So I got to tell you, it was monumental news this week. On a Wednesday, we had Federal Reserve Chairman Warsh have his first meeting. And I tell you what, people were like, do I give him an A, a B, or a C? I'm going to give him a B plus, A minus. I actually thought it was good. But the reason I'm talking about this is it was a game changer. I mean, the story should be how the new Federal Reserve chairperson, Kevin Warsh, is actually intending to redefine some of the Fed. And that's got implications for savers, implications for borrowers, and definitively has implications for investors. So let's break it down because this is information that you absolutely got to have. So part number one, Federal Reserve communications. This might be the most important change that I see. For the last 15 years, the Federal Reserve has been swimming in transparency. They publish very detailed forecasts, give us these dot plots, tell us everything they're thinking at the press conferences. They leak out the speeches. They give forward guidance. And you know what? Warsh came in, the new guy. He said, hey, the Fed's become too talkative. He wants the markets to focus on economic data rather than trying to decode sentences from the Fed. So what's the takeaway from this? You got to expect fewer hints, less forward guidance, potentially more surprises. So Kevin Warsh is rolling back what Yellen did, what Bernanke did, what all these people have done. This goes back now to a Federal Reserve that might operate a lot more like it did in the early 90s, the early days of Greenspan's tenure. So what do I tell you to take away from this? Powell's Fed, he gave investors GPS directions. It allowed the market to be more stable. Warsh, they're not going to give us GPS directions anymore. They're going to hand us a paper map. That's a little bit more difficult to interpret. David, any comments on that? Because I want to give the others so we can get into the investor implications that I'm kind of hinting to.
I think the only takeaways are, one, more volatility. Two, he's going to spend his time creating these other committees. I'm not sure what that actually means because it seems like they're just trading one job for another. But three, I think, is you had 9 members out of 18 expect rate hikes in 26. We have a divided committee, right? Because it's not just Warsh, right? There's people behind them that agree on the decisions. And then Warsh is the mouthpiece to explain why or why not. And I think that suggests that, we're not in the same environment, and perhaps the way people came invested into this year, the markets are pushing back on that. And that's going to force investors to make some changes to perhaps the safer portions of their portfolios, which is the bond portions.
Yeah, that's right. I'm going to tell you more of what that means because Warsh wants, the new Fed chair, we're talking about his first testimony just happened this week, the first big meeting. And the new Fed chair, Warsh, he wants the Fed to be a referee. He doesn't want the Fed to actually be a player in the game anymore. And he's really looking at the balance sheet. And if he changes the $6.7 trillion in assets, this is all the quantitative easing stuff. It might mean less liquidity in financial markets. It might mean a more durable but higher long-term interest rate, greater price discovery, and less government influence, more free market influence over asset prices. So you're wondering, what does this mean with your money? Well, I think it means you got to buckle your seatbelt. You're going to have to prepare for more volatility, as David alluded to. And that means your professionals that you hire are going to have to be more active amid the uncertainty. And there is uncertainty out there. One of the things that he was very clear to say is he's been questioning, the new Fed chair has questioned whether or not we can continue to run a 21st century economy with 20th century data. Let me say that again. Can you continue to run a 21st century economy, which clearly we're in now with artificial intelligence, with 20th century data? I don't know that you can. And that means investors really need to take a look. So let's turn this into strategy. So in closing, I say, listen, the new Fed chair, he's appointed by Donald Trump. I gave him a B+, strong A- in his opening meeting. And what is he doing? He's not just changing monetary policy. He's changing the Federal Reserve's operating model from one that's communicative, data collection, inflation targeting. He's really just saying, hey, investors, you got to start paying attention not to the next quarter point move in rates, and you better pay more attention to the rules of the game. He's rewriting those rules as we speak. So I think part number one, David, we've been talking about the implication in the bond market, and I think this screams, if there's going to be less transparency from the Fed, that people should demand, expect, and implement with more permanence and definition in bonds, because it's too easy to get caught off sides. What am I talking about, and how are we fixing it at VestGen Wealth Partners?
Yeah, I think an important takeaway is, let me give you the probabilities quickly, right? So the probability of a rate hike in July jumped from 10% to 32%. The probability of a rate hike by October surged from 42% to 100%. Now, here's the takeaway. If you think they're going to raise rates, the normal takeaway is you're going to take action, shorten up duration in your portfolio. But if they've already gone from 42 to 100%, the market's already priced that in. So I think the smarter thing to do as an investor is to not guess. You don't want to guess what the Fed's going to do, because there's plenty of people with lots of initials after their name that have been trying to guess what Fed policy is going to be, and you usually get caught. At VestGen, we're trying to strip out the guessing. And what we're saying is we're going to build an income plan for you, not based off if rates are going to go up and down, but we're just going to simply lock in our maturities so that regardless of what the Federal Reserve does, we have a known outcome. Assuming no default, if we buy bonds and hold them to maturity, we get our money back plus all the interest payments. And in a world of all of these unknowns today, if you're going to invest 20% of your money, 30% or 40% of your money into fixed income securities, why keep all of that volatility in that part of your portfolio that's supposed to be the safe money? Just change the style, change the implementation to the individual bonds so that you can remove that uncertainty for a portion of the portfolio. Because you can't remove the uncertainty for the stock market. That's too hard, but you can remove it from the bond portion of your portfolio if you just think about implementing with different vehicles.
So start incorporating individual bonds. If not individual bonds, start incorporating defined maturity, target maturity bond funds, like a fund that is 2028. Because guess what? All the bonds mature by December 31st, 2028. You know when the principal is coming back. You can calculate your specific yield to maturity. And by holding to maturity, you diversify away the interest rate risk, which apparently is going to be much larger for everybody under a worse tenure at the Fed, given they're going to be a little bit more humble, a little bit more quiet, and allow markets not to lean on the Federal Reserve as a crutch, but markets are going to have to be data dependent. So if you too are ready, because you've outgrown just owning broad-based bond indices, you've outgrown just owning bond funds, you too want to add permanence and definition and work with a firm that's got a strong institutional presence, multiple fixed income trade desks. You want to learn what it means to have target maturities in your portfolio, whether we're talking about a barbell, a bullet, or a ladder strategy. I want you to connect with us at 833-964-PLAN. That's 833-964-PLAN. Go out to our website, getretiredstayretired.com. Getretiredstayretired.com. Don't ignore the 20, the 30, or the 40. That's the 20%, 30%, or 40% of your portfolio that's in fixed income. That deserves a higher level of care, and we can do that for you. You're listening to Craig and David Bolanos, VestGen Wealth Partners. This is In the Know Radio on AM 560, The Answer.
It's more In the Know Radio with Craig Bolanos on AM 560 The Answer, where his goal is to pummel you with financial know-how until you say uncle.
One of the newest financial planning opportunities for families, you know what it's called, you like it, I like it, it's a Trump account. There's been so much discussion about what these accounts are, how they can benefit children over the long term, and I want to break it down for a couple of minutes again. Think of these Trump accounts as a long-term investment account designed to give children a financial head start. The government provides an initial contribution for eligible children, and then parents, grandparents, businesses, they can make additional contributions over time. What's the goal of this whole thing? It's so simple. Get Americans investing earlier, build wealth from basically when a child is born rather than waiting to adulthood. So you're probably going to say, Craig, David, you guys are so excited about this concept. Well, yeah, because it harnesses the most powerful force when it comes to investing, Time. And as advisors, we always tell clients the single biggest mistake investors make, it's not picking the wrong investment. It's not putting it in the wrong type of account based on taxes. It's starting too late. And Trump accounts potentially give kids a ginormous head start on this. So again, how do the contributions work? You can get $5,000 into this account per year. That $5,000 is going to grow tax deferred. That $5,000 contribution per year gets invested in great companies of America through an index fund. At the age of 18, this money can be unlocked and used for education, or better yet, this money cannot be tapped, and it can simply sit on the shelf and grow for decades and decades and decades. And I don't even want to tease you with how much money could end up in one of these if you found a way to actually fund it at a rate of $5,000 per year each year for 18 years. But you're literally setting up the next gen for retirement before they've even graduated from high school. 833-964-PLAN. That's 833-964-PLAN. Call us today. Learn more about Trump accounts. Want to read about it? Go to GetRetiredStayRetired.com. That's GetRetiredStayRetired.com. Download our free publication on Trump accounts so you too can set up the next generation to win. And again, in America, we win big. David, coming into this block here, the D block, what are some of the most impactful things that you think clients are making queries about, whether it's investing, whether it's insurance, whether it's planning? What are you hearing on the front lines as a wealth advisor at VestGen Wealth Partners?
I'll break it down into several different topics. Let's talk about gifting, because I view this as a form of gifting. A lot of families that we work with feel like they've made it. They've internalized the last couple of years. They have enough money on the back of good market returns. We feel like we're in good shape. Well, how do we perhaps pass that money on? I'm sure you hear in the conference room all the time, Craig, families will joke. They say, when we're gone, we don't want any money going to the kids. But we know they're just joking, right? They're not going to spend every dollar to zero. And I think maybe 20 years ago, there was this thing of like, I want to die with the most amount of money we've ever had at exactly the time and point we don't need it. But what you are seeing more often now is parents want to help their adult kids. They want to help them get into a good neighborhood that might be very overpriced right now. They've seen the power of compounding work in their investment accounts, and they want to encourage younger investors to do so. And Trump accounts are going to be a great example of that. And as clients rebalance portfolios, I've done this several times this year as we've looked to move stock out of portfolios, as opposed to selling it and then reinvesting it. I've opened several brokerage accounts for children where we've just pushed shares of appreciated stock. So pick your favorite tech stock. If mom and dad want to jumpstart little Johnny's investment account, encourage him to maybe start funding an investment account. Then we push the shares of appreciated stock out of mom and dad's trust into their child's portfolio. Now that child can hold on to that tech stock long term. It's extremely tax efficient. Mom and dad aren't registering a capital gain sale, but we're planting seeds for the future. If we just do that for a couple of years, just like a Trump account, that's going to make all the difference long term. So I would say number one is being more creative with how we're giving money to the next generation, or in certain cases, how we're giving dollars to charitable endeavors through QCDs or through donor advised funds.
All right, so it's all about gifting. So if you want to learn more about gifting, not just to charity, but gifting in the family, and you want to move beyond the idea of helping them fund a Roth IRA, fund a Trump account, moving beyond the idea of the simple 19,000 gift limit, you want to help them with property, you want to help them with business, you want to help them with a multi-member, multi-manager series LLC, you've got one place to call. That's us, 833-964-PLAN, 833-964-PLAN. Go out to our website, GetRetiredStayRetired.com. Let's elevate your gifting strategy into your current adult children. Let's go from usual and customary to what I call gifting on steroids. Because after all, this is America. And in America, anything's possible. We're talking about topics that clients are consistently wondering about with one of VestGen's top advisors, David Bolanos. David, beyond just the gifting concept, what else are you hearing on the front lines when you visit with people in the conference room or virtually through the computer?
So what we talked about in segment 1, which is marginal tax rates, where you're at today, but where you're likely going to be in the future. And we like to do that by just actually going through the numbers. CPAs are awesome at preparing tax returns, but I often find that sometimes the communication isn't as good as it needs to be. There's tax preparation and there's tax strategy, and we do an excellent job at VestGen of trying to break that down in the simplest terms to stay at those marginal tax rates. So I'd say that's number 2. And where a lot of this is coming from, Craig, is how these investments flow through your tax return. And I'll point one thing that's been top of mind. We spent a lot of time this year and last year talking about non-traditional investments, private equity. And I'll mention this, private equity is hot. I don't think we've seen money moving this quickly for a long time. I hear that a lot of times from attorneys that we work with. And so that means that family businesses are now on the for sale block, and people want to get these sales done in the next couple of years before tax rates could go up. But with the sale of a company, a stock sale oftentimes comes a large tax bill. And VestGen is very well equipped through some higher end investment strategies to help mitigate those taxes. So if you're out there, and Craig, I'll pass it over to you to talk about this, but if you're out there, a small business owner, which we love because we ran Building America, which is a show all about the U.S. business owner in America, and you're saying, you know what, I'm in 24 months out from my liquidity event. What's one of the ways, Craig, that we can help business owners get ahead of that potential liquidity event so they keep as much money as they can from that liquidity event?
Yeah, that's right. Because at the end of the day, David, the goal isn't about building a large portfolio. The goal is about creating a retirement where your money works for you, not for the IRS. So here's how we're going to do. If you're ready to start selling off some parcels of real estate, you're going to do some sale leasebacks. You're going to go ahead and value and get liquid on your business, whether it's a multiplier of EBITDA, seller discretionary equity, EPOC, all these different things. You should work with the business valuation consultants and the advisors at VestGen Wealth Partners so we can start incubating before your liquidity event happens strategies, whether it's direct indexing, whether it's direct indexing on steroids, I call it long short, whether it's direct indexing on steroids, long short with leverage, whatever we can do to start putting what I call passive activity losses and or capital losses while you still make money into the lost piggy bank so that when your liquidity event comes, you're paying as little to the taxing authorities as you're legally required to do. That's not just an investment thing. It's not just a tax thing. It also might be an estate planning thing by creating the right ownership and entity structure before the liquidity event to maximize your after-tax value. That's where VestGen comes in. You're listening to Craig and David Bolanos, VestGen Wealth Partners, in the Know Radio, AM 560.
Okay, Windy City, get ready to be blown away with a hefty gust of financial know-how. You're listening to In the Know Radio with Craig Bolanos on AM 560. The Answer.
I'm talking to the business owner out there right now. The first question you have is, what is my business really worth? You need to start getting a business valuation. I want you to contact your friends at VestGen Wealth Partners to help you orchestrate that business valuation so you can start being realistic about your exit plan, aka are you going to have the right value to achieve the wealth, the freedom, and the independent living that you've always wanted. Once that valuation's done, then you're going to need to go through the process. That's the process of a roadshow. Whether you're working with a business broker, whether you're going to go to a strategic competitor, whether you're going to go to an aggregator, whether you're going to have a full investment banking process, you need a coach. a coach who's going to talk the language and bridge the conversations from the professionals down to you, because ultimately it's about you and your family. That being said, I think it's really important that you tie in the other concerns. The concerns is what we just said in that last block, mitigating the taxes. Those are the taxes now. Those are the taxes at liquidity, the sale of the business. And those are taxes because if you live in Illinois, you do not want the long arm of Springfield. It's called Illinois estate taxes taking a piece of the action. And if you've been really successful, you got to worry, even with these high exemptions, about the government taking a piece of all of your sweat equity. That's where various forms of trusts end up coming into play. The most common, spousal lifetime access trusts, SLATs. Let us educate you on how a SLAT might benefit you and yours today. Let us educate you on the intersection of all of these different things, because the time to prepare for the business liquidity is well enough in advance of the business liquidity so that you can be fully and solely focused on the sale, knowing the pre-planning has already been done with your friends at VestGen Wealth Partners. So I invite you, if you're a consistent listener to this show, just to connect with us. We are your resource. We are the family office. It's the investments, the financial planning, the cash flow modeling, the estate and legal, the taxes, the retiree healthcare, the business valuation, you name it. That's the enterprise. That's the ecosystem that defines VestGen Wealth Partners. We're vested in your success, that success of creating and driving generational wealth. 833-964-PLAN. Go out to our website, getretired, stayretired.com.